From my experience, whether I've worked with a church or a temple or any other type of a religious organization, meaning a nonprofit, many of the times these organizations don't actually have the down payments available in their checking or savings account. They actually raise that money from the members of the organization, which could be a problem because when a lender looks at a transaction, they would like to see that you actually have the money available to be able to purchase that particular piece of real estate before they start spinning their wheels. Because if you don't have the money day one, then why would they count on you to have the money in a month or 2 months from now? It could be a waste of everyone's time. So in this video, I want to share my experience with you. I want to make sure that whatever mistake I make, I share with you guys. So hopefully you don't make the same mistake that I did. My name is Zevi Schaff, and if you don't know who I am, I'm an owner of a finance company in Los Angeles, and I appreciate you guys being here. If you enjoy this video, please make sure to give it a thumbs up so other people like yourself can find it on the web. With that, let's get started. So what exactly did I do? Last week, I was working on an acquisition, on a purchase for $2.5 million commercial building right here in Los Angeles. And the client that I had made me feel so comfortable in the sense that they had enough money in the bank to actually purchase this piece of real estate in cash. And therefore, I felt like they were extremely qualified. They wanted to make sure that they actually close escrow on that piece of real estate. So you might be asking yourself, Zevi, oh, that sounds really great. What exactly is the problem? Here's where it gets interesting. This particular borrower is a part of a religious facility. And in those facilities, typically, when you buy a piece of real estate, many of times you actually raise the money to do so. From my experience, whether I've worked with a church or a temple or any other type of a religious organization, meaning a nonprofit, many of the times these organizations don't actually have the down payments available in their checking or savings account. They actually raise that money from the members of the organization, which could be a problem because when a lender looks at a transaction, they would like to see that you actually have the money available to be able to purchase that particular piece of real estate before they start spinning their wheels. Because if you don't have the money day one, then why would they count on you to have the money in a month or 2 months from now? It could be a waste of everyone's time. Now you might be thinking, wait, but you just said that they had enough money in their bank to buy this in cash. They did, personally. And it's completely up to them whether they wanted to use that money or if they wanted to take the time to try to raise that money, which is kind of where there are blurred lines in these type of transactions. And let me explain this to you. This particular individual was okay with using their own money. However, when it came down to it, they decided that it would be a better idea for them to raise the money versus use their own money to close on the transaction. And this is where it gets sticky. The lender already verified the funds, and because they did, they were on board and issued the terms. Now, mind you, typically, and this is where the mistake unfolds, I would have a borrower review my terms once, of course, I receive them from whether it's the bank, whether it's the investor, whether it's the fund. Once they green light my agreement and they sign my term sheet, at that time, they would have to issue a processing fee of anywhere between $1,500 to $2,000. Two things will actually happen when you do that. Number one, the borrower feels a lot more committed to the transaction because now they're actually somebody who wrote a check to be a part of this transaction. It draws the borrower in. Number two, if they don't perform on the transaction, at least you recouped some money versus working for free for the next 30 days. And that has always been my approach on every single commercial deal. I've learned from many deals that when I don't do that, there's a very good chance that the borrower will not close escrow. And if they don't, then I've spent all this time working for free. In this particular case, simply because the borrower was so financially strong and they had the full intent of closing, they last minute decided that they will try to structure this particular transaction as a cash deal. And so whatever time I've spent with this individual over the past 30 days plus has basically been flushed down the toilet simply because I did not collect upfront my processing fee, which I tell you guys to do every single time. So if you're somebody who's trying to get into the commercial lending space, I have developed a program that I call the Part-Time Commercial Lender Academy, and it's available for you in the description below. And basically what it is I took 10 years of my knowledge and I packaged it into a program that is very easy to follow, plug and play with all forms that I've created, my proprietary work that I still use until today to close all my transactions. It's available in the program, and if you want to check it out, again, in the description below, I will provide a link to it. If you have any questions for me about this particular transaction, just drop them in the comments below. I'll be happy to answer them. The takeaway is, when you're working on commercial transactions, there's two things that are going to take place. Number one, you're going to agree with the borrower on a set origination, meaning the amount of money that you're going to get paid. Number two, if you're working with a participating broker, you can actually write their company into the term sheet and both parties can get paid through closing. There are caveats to that, which I'm not going to get into in this particular video. And the third piece is, if you're going to spend your time with any borrower for a period of 30 days plus, make sure that you're getting a processing fee paid once they signed your terms. You can only do that, by the way, in commercial lending as a business loan. It's not something you can do on a residential transaction. That would be considered illegal. All right. As always, I appreciate you guys. If you enjoyed this video, please remember to give it a thumbs up so other people like yourself can find it on the web. If you enjoy my videos in general, feel free to subscribe to my channel. Otherwise, I thank you, and I'll catch you again on my next video. Take care.